Hello traders. The title of the video is Simple Hedging Strategies that have stood time. All right. Before we continue, I would like to remind traders that recently I have recorded a video that we title Role of Central Banks in Recession. That video was posted at George Trio YouTube channel. Please check it out. There are three roles that the central bank are playing. The first one is to boost the economy. The second one is to put in place policy. And the third one is to combat the inflation. So you may say, George, I'm a day trader, I'm a scalper, I'm a swing trader. Okay, I do not want to know about the central bank. Okay, I will say to you it's a mistake. Check that video, please. All right, very, very important video. Let's get started. All right, simple hedging strategy that have stood time. Be sure to subscribe to our channel. Okay, before you forget. All right. So anytime we record a new video, click on the notification bell. So anytime we record a new video, you will be the first person to be notified. Simple hedging strategy that have stood times. All right. So when it comes to hedging, all right, is that one is holding a position, all right, and one understands that, okay, if you buy, for instance, you know that it can go down, all right. So you want to take another position so that when, okay, what you are expecting is not taking place, all right, you can be compensated, all right. This is about hedging. So imagine that I bought gold, all right? I bought, for instance, gold, all right? Or I have a lot of gold in my house, all right? Or I put a lot of, or 20% of my investment of fund into gold, all right? So my expectation that gold will go up, yes or no, all right? But it will be completely nonsense, it will be completely wrong or even foolish for me to think that definitely gold will go up forever. So the question we are asking is that what will happen to our portfolio, all right, if gold is not going up and start going down instead? So we want to put in place measures that will help us to compensate for that because we believe that gold will go up, but we also understand that it may not go up. This is what we do all the time. So risk management. So you are day trading, swing trading, position trading. That's why I say to traders, don't don't come to the market, all right, and just say that definitely it's going to go down or definitely it's going to go up. You will be surprised. The market will do the opposite. So, with that thing in mind, you want to protect the other side, so to speak. All right? So, because I have a lot of gold, so I want to find another financial instrument that will do the opposite of gold. This is about hedging strategy. Very simple. So I'm holding gold. I know that if gold is going up quite often, the US dollar is going down. Okay? All right. So these are two assets that are doing the opposite. So when one is going up, all right, the other one is going down. Okay? When the other one is going up, the same thing. So they all doing the opposite. So they don't do the same thing together. So in order to protect my investment in gold, because I'm a little bit afraid that my expectation may not be fulfilled, I want to find other financial instruments that are doing the same thing like gold. So what I need to do now? So the question we want to answer is that, well, how do we protect the gold that we are buying? So gold is going up. That's what we want it. If it's going up, it's all good. We'll be very, very rich, yes or no? Now we are not foolish investors. We want to have a defensive and protective measures in place. So ordinary traders use a stop loss and so on and so on. All right. So those are methods that we use. This is why I was saying to traders that if you put two traders together, all right, you give them 7 trades. They trade in the same financial instrument. One had a 5 winning trade out of 7, and another one had a 3 winning trade out of 7. But you may look at it and say straight away that the person who had 5 winning trade is the best trader, but that's not the case. The case is that how much money did one lose during those 7 trades, or how much money do they make? Because the bottom line is all come down to the money. not the number of trade that one has taken. So, in order to become a better trader or an investor, you want to control the risk. And one method to control the risk is hedging. I need to remind technical traders, couple of day traders, that most of the market participants that are using a simple hedging strategy are long-term investors. Talking about position traders, all right? Position traders, all right? Hedge fund, all right? Long-term investors. Technical traders do use also hedging tactics, especially those that are trading currencies, Forex or FS. They are using it all the time. But a stock trader can also apply, okay, hedging strategy. So now we want to answer the question, okay? So suppose gold start going down, what will happen to the dollar? All right? So when gold is going down, our investment is depreciating, is going down. We say, oh, that's not what we want. So gold will be going up. So it makes sense in order to protect our gold position. When we are buying gold, we'll buy straight away also the dollar. So we have, it's up to you, all right? It's up to you how much downside you want to protect, all right? This is it. So there is a rule that a lot of investors are following is that they never invest more than 20% of their investment fund in one sector. So it's up to you, all right? So now, so we buying gold and then we buying dollar at the same time. But understand this. So when our investment, we have a lot of gold, we want to protect this. So the hedging is a kind of insurance that we are buying. So by buying the dollar is an insurance against the downside that we do not want. See, but I want to give it to you in a simple way. That this is just in a nutshell what is hedging is all about. So before I forget, if you hear the word hedging, think of gold, think of dollar. That's it. First two things you need to understand, gold and the dollar. All right. Now, you may say to me, George, I'm a stock trader. All right. So what is happening in the stock market? All right. In a stock market, all right. So when people want to take risks or expecting more, okay, reward out of the risk that they are taking, they go to the stock market. So they can double their money, okay, they can triple their money, okay, they can have a stock going up 10 times the price where they bought it. So they are taking risks, all right? The risk is quite high. So now, how do you protect your long-term investment in the stock market? All right? How do you do that? All right? So you want to check carefully, all right? This is it. If the stock start going down, people will start buying gold again. That's why I say to you, anytime we are talking about hedging, the first two things that you don't want to forget is gold and the dollar. Usually, the stock market will be going up for a while until the inflation. So that's why I said to you, watch the video that I said to you, role of central bank in recession. The central banks, right, the central banks, their enemy, the enemy number one of the central bank is what? The inflation. They want to control the inflation. All that video is only 90 minutes, please. So how the stock market function? All right. So for us that understand the easier way, we know that the stock market will go out 1, 2, 3, 4, 5 ways, and then we have a correction. When there is a correction, people call it recession. We call it correction. It's a market phase, and we don't have anything against it. In fact, easier way traders do not call it recession; they call it correction. There are different type of correction. All right. There are correction that we call WXY way. During the X way, people think that it's a trend, everything looking good, but it's not finished. There will be another correction again. So you have WXY way. So the general public think that, oh, right, we are having an economic boom out of the blue. We have the Y wave. Am I talking too much? Okay, all right. So stock market is going up and you bought it. You want to protect the downside. Okay, this is it. So people that are putting money in the stock market, I know that at one point the stock market will start coming down. So where do you start buying your gold? It's a very simple rule. You want to always buy low, all right, and sell high. So even if you are hedging a position, you don't have to buy, okay, if you're, for instance, protecting your stock portfolio, you don't have to buy gold at any price. That's crazy, all right? You pull back to a certain level, you buy it. Otherwise, your hedging strategy will not be efficient. Now, this video is not about how to make a hedging strategy more efficient. It's about, okay, simple hedging strategies that have stood time. This is what we are discussing here, all right? So a smart stock market trader, all right, who understand the market, for instance, see the first wave, the second wave, and the third wave, all right. At the end of the third wave, that person may decide, okay, may decide to start buying gold because that person may say, all right, soon we have the fourth wave and the fifth wave. So that person may start, that stock market trader, investor may decide, start accumulating gold because they know that sooner or later, the market will peak and there will be a correction that people will call a recession. All right. So it's all down to the timing. So one way to control or to improve the hedging strategy is to improve the market timing. That's a different topic completely. So somebody in the stock market, all right, may buy gold to protect the portfolio. At the end of the day, we are talking about the gold and the dollar. So what the dollar has to do now? The dollar is about the inflation. Okay, so this is it. We talk about the central bank controlling the inflation. So usually the market going up for a while. Okay, inflation maybe also picking up as we are reaching the top of the market. And now the Federal Reserve has to control the interest rate, talking about being a dovish policy, dovish, right? Dovish, dovish policy. It's about cutting interest rate. So interest rate was going down for some time. Inflation was going down for some time. All right. So they want to reverse the policy. All right. So that they have to cut it. This is the dollar will come in now. This is it. So the dollar, all right. If they cut in interest rate, the dollar will start coming down big time. Dollar coming down big time. So somebody that is selling, all right, that is selling a financial asset, all right. So suppose you are here, you start selling the stock, you selling the stocks, all right, big time because you expecting it to go down. The market will go down in the fifth either way. What do you need to do? You need to sell also the dollar. Why? Because when the stock market, when you sell the dollar, when you expecting so no, my apology. Yeah, if you are selling the stock market, you are expecting, okay, that the market will go down. All right. Now, what you need to do, if the inflation, this is very important because it's depending on the policy that they are making during that time. If the inflation is high at this point also, where the market is, so meaning that the market is peaking, all right, or reach a resistance level, and also, all right, the inflation is high. This is it. Two things together. Market going down, reaching the peak, and at the same time, inflation going up. Yes or no? All right. So what will happen? It will happen that when the market peak, if the market peak, they will start devaluing. So somebody that hold the stock and understand also the inflation that, oh, all right, I'm holding stock and I'm buying gold at the end of the third year wave. And now here we are, the inflation is also peaking now. What should I do again? I can also sell the dollar. Because if the Federal Reserve starts devaluing the dollar, if they start changing the monetary policy to control the inflation, the dollar will go down. So we start the dollar going down. What does it mean? This is it. Dollar, anytime you think of dollar, you must think of gold. So if you are selling the dollar in order to hedge those bearish positions, what do? You will sell also gold. All right. So All in all, you need to pay attention to gold, you need to pay attention to the dollar, and you need to pay attention to the inflation. So those are the three things that you need to consider anytime you are talking about hedging. Where is the inflation now? What the central bank are likely to do, all right? And that will determine your strategy to put in place a viable hedging strategy. It is completely wrong for somebody that is involved in hedging activity in the financial market to ignore the central bank or the inflation. This is a common mistake because very often most market participants that are involved in hedging activity will only pay attention to the gold and the dollar. But they could improve those hedging strategy by paying attention also to the inflation, because the inflation is from the inflation, the Federal Reserve will start making decisions, the central bank will start making decisions that will affect the dollar or other currencies. So this is it. So when we are talking about the dollar, we are also okay. So trader, when we are talking about this is it. So if you pay attention to this one also, when we are talking about gold, we are generally talking about commodity. So if we extend our hedging strategy into sector, we will say that okay, when the stock market is about to go down, as we see in 2008, the commodity market is likely to go up. All right. So at this point in time, you decided to hold on to your stock. You don't want to sell it. You don't understand the illegal way. You are just an ordinary investor that like to buy and hold. All right. You will have to buy, okay, to protect your uh, portfolio for stock, you have to buy commodity or gold or buy the sector of the commodity. All right, this is it. If you are selling the dollar, you're expecting the dollar to go down, all right, big time. In order to improve that strategy, you need to pay attention to, all right, the central bank, the inflation, all right. You can also play with a correlation between currency pair. So those that are trading forex, we know that if the euro dollar is going up, all right, the US dollar Swiss franc will be doing the opposite. All right. So those that are buying the euro dollar currency pair for day trading, scalping, swing trading, some of traders are using those hedging positions. So they will buy both currency together. I can assure you that if you do not know how to do it, you end up losing. All right. Otherwise, it will be easier for everybody to come into the market every day and just buy the euro dollar and then buy the dollar Swiss franc. All right. So you may say, all right, so this one is going up. Okay. All right, this one will go down. All right. So whatever happen, I will get paid. So if I buy, for instance, that go whatever you see, so it doesn't matter because they're doing the opposite. All right. And you expect it to be, you buy it. So you buy it. Okay. You buy this one. Okay, and you buy this one also at the same time, both together. All right. So you buy the euro dollar. That was your original intention to buy the euro dollar. Okay. You buy, you want it to go up. Okay. But you decided to protect that position by buying also the dollar, yeah, the dollar Swiss franc, because you know that the dollar Swiss franc will be going down when this one is going up. But behold, your decision was wrong here. You buy the euro dollar, but it start going down. Yes or no? So you are losing. But because you also buy this one, if this one is going down, okay, this one will go up. So you have two positions, all right? If this one is going down, which is a losing trade, this will be a winning trade. But it doesn't work beautifully like that all the time. This is a different matter that we discussed already about correlation between currency pair. But this is it. In order to improve the hedging strategy, this is what we are talking about all the time, it's all down to the timing. How do you time it? And the timing and the market environment will help you. So all in all, this is a very simple tutorial about simple hedging strategy that stood the time. So we will talk about bonds, all right? So the bond again, so we're talking about bond, we are talking about money again, the inflation, all right? So remember this. If you are involved with bond, you are involved with the dollar, you are involved with the central bank. This is very, very important. This is it. People go and buy this and buy that and say they are hedging, but the timing is wrong. It's when the central bank, which are the referees in the financial market, signal to the market what they're about to do. That's what people do. If you look at the dollar yen, the Federal Reserve from 2012 start telling the market that they will put up interest rate. That's a very good news for those position traders. It's time to buy the dollar. That's it. So as they start saying it, that they're going to do it, everybody know that they ring the bell now. It's time to buy the dollar. All right. So when they're about to start to devalue the dollar, they were saying it. All right. We're going to become dovish. Dovish policy, hawkish policy is the opposite. So now everybody know they're going to devalue the dollar. What do? You sell the dollar, and what do? All right. People know that the gold will be going up. Now, those are two different positions. Now, if you want to hedge them, three things you need to consider. All right. So this is it: gold, dollar, inflation, or central bank, all together. All together. You are dealing with currency, the same thing again. You are buying the euro. You want to protect against use the dollar yen. There are other things that you need to take into consideration. It's not one plus one equal two, and it's all working well. Usually, the hedging position work well at a reversal point. So market is going down, okay, this is it, going down, and it reached the top. This is it, all right. The smartest investors, all right, they will try right here. They want to sell now. They know that the market has peaked now. So this is a reversal point. So they know that the market has peaked. They receive a signal to sell at the top of the market. The inflation probably is also high. And now they say, wow, what's going to happen now? Or the inflation is low or whatever it is. They pay attention to the inflation because those are the three things. And they want to sell the stock market because they know that it's all ringing the bell to sell. So they want to become bearish market participants. They need to be careful. If they're going to hold many positions or large positions or colossal positions, they will not go one direction, unidirectional. They will hedge their position. So the question is, we are taking the downside, okay? How do we protect the downside? What will happen if the market continue to go up instead? So by asking those essential questions, you'll find a real candidate to 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 protect your position. Talking about medium term, long term, or short term. All right. So this is it. So you are paying attention to the correlation between sectors. Stock market is about to go down. Where the money will go? The money will go to the commodity and to gold. Yes or no? All right. Commodity market is going to go down. Where the money will go? The money will go into the stock market. But you have to understand that between the stock market and the commodity market, between the stock market and the bond market, we have what? The interest rate, the Federal Reserve. So people buy bond. Why people buy bond? People buy bond to earn interest on it. When is the best time to buy bonds? Is when the Federal Reserve is talking about putting up interest rates. Yes. So we know that they have been devaluing the dollar for a long time. Sooner or later, they're going to start putting it up. What do? You can gradually, in a timely fashion, buying at a specific price level, start buying gold, bonds, and holding them, talking about long-term purposes. This is it, isn't it? All right? This is it. So at a reversal point, or at a time when the policy is about to change, looking at the indicators like gold, okay, inflation, and, all right, the dollar, yes or no? So we will go on and on and on with hedging activity. People will talk about crude oil. But in a nutshell, we are talking about gold, all right? You are talking about the dollar, and you are talking about the inflation, and you are talking about the Federal Reserve. And so to improve or to become a better, okay, trader that is applying hedging strategy, all right, you want to always time your strategy carefully. So Like in 2008, all right, the Federal Reserve start talking. 2012, the Federal Reserve start saying that they're going to start putting up interest rate. I can show you now. Hold on, please. I'll show you very fast. Uh, Dollar yen, because this is a very important topic that traders are neglecting. But one thing I need to tell those that are already involved in hedging strategies that the timing is very, very important. That's why traders, a lot of market participants are struggling because they are just using hedging anytime, anywhere. This is it. So here it is, you see. So from 2012, you see, 2012, there's a reverse of policy. Those are the best time. So the market is about to change, the policy is about to change. You want to buy the dollar, okay? Big time, all right? Keep buying it over long term. How do you hedge that position? So it's not the hedging activity taking place anywhere, anytime, in the middle of nowhere, in a timely fashion. That's how it will work. Okay. So how much insurance are you willing to buy? So it depends. How are you protecting the position? Okay. So this is it. But you have to consider the hedging as an insurance for your position. You are on a mission to make money, but you know that the opposite may happen. But now, how you want to control it? How much loss are you willing to accept reasonably? All right, this is it. Okay, so you see, from 2012, they start saying, saying saying As soon as they start saying it, the people start buying the dollar. This is a dollar going up, God, dollar appreciating against other currencies. Okay, so before the beginning of 2000, you see, this is a 2008 somewhere here. They were saying, "Oh, we're going to start cutting interest rates," so people start selling the dollar. This is the bell. Any hedging activity should be timed with the central bank. This is it. If you forget the central bank, and your hedging decision will be completely wrong because it's at the wrong place, the wrong time, and doing all kind of thing. And at the end, you end up with a mess where you have maybe even a two losing position, and you are struggling with both positions instead of one compensated to other. But to avoid all those nonsense, one should see the hedging not like a bunker. All right, don't see it like a bunker. Okay, meaning that I don't want to take any risk at all. All right, don't see it like a bunker. Don't see it like I don't want to lose at all. With that, I will never lose. No, that's not the approach of the hedging. The ultimate goal of applying a hedging strategy, all right, is to take it as an insurance against a position. That's it. That's all. So now, how much risk are you willing to take? How much insurance are you willing to pay for that position that you are taking? If the most important thing is the timing. If the decision, usually people will be correct about the direction of the market. They say, oh, we need to buy gold now. But they are buying gold at the wrong time. They were correct that the gold will go up, but they bought it at the wrong time and lose fast. So if your timing is correct and you buy the insurance, all right, are you willing to pay 20% insurance or 40% insurance? At the end, you will notice that your decision of hedging is good. So it will all work well. Your your decision was correct. Your insurance was in place, but was not needed. That's all. That's why people buy insurance, isn't it? So people buy insurance, warranty, all these things, in case anything happen. And if nothing happened, people will say that you waste your money buying insurance. But it was there just in case something happened. So it's not okay a bunker where you hide and nothing okay can touch you. All in all, this is it. Three things you must remember when we are talking about hedging is what? Gold, dollar, and the inflation, talking about the central bank, most importantly, the Federal Reserve of America. One more thing before we go. I'll show you also the S&P 500, same thing. So you see the dollar was going up from 2012 up, all right? So the stock market, you have to see that when people are buying the dollar, okay, it means that they are purchasing good in America, yes or no? Or so if the value of Australian dollar is appreciating, or if the value of Swiss franc is appreciating, it means that people are buying good in Switzerland. There is money coming into that country. There is a demand for that currency. So if there is a demand for that currency, probably they are buying a lot of good coming from that country, and it benefits the stock market also. So the same thing you can see here from 2012, as the dollar starts recovering. Look at this. The stock market is also, there's now a demand for the dollar. Here it is going up big time. Now the market is going up. We are talking about, you see now, so this week you can see here it's breaking that resistance there. Okay, 294. Okay, one. The S&P 500, S&P 500, 2941. That's what we are talking about. Okay, so the timing is the key. Okay, so this is something very important. That's why I'm repeating it, because a lot of traders go around and learn about hedging, and no one is talking about timing when they are talking about hedging. It's completely wrong. There are point position where people are in a timely fashion, they enter the trade, in a timely fashion, they buy the insurance in the shape of hedging activity. But people going around jumping like kangaroo, all right, this to make you laugh a bit, all right, or donkey, okay. Do all kind of hedging activity. When I start trading for SPF, people say to me that all you have to do is to buy the euro dollar and buy the dollar Swiss franc at the same time. I've done it a few times and it didn't work because the timing was wrong. The timing was wrong. The timing was wrong. Okay, the timing was completely wrong. The place, the position. So you want to work with market principle prior reaching a target level. Okay, as a day trader, you can work with that. Swing trader can work with that. Price doesn't go up or down for no reason. It's always headed to a specific target level. So those are the point where you take the hedging position. But the hedging is not when you are buying insurance, so you have something that has a value of $1 million. How much insurance are you willing to pay on that 1 million? Straight away. Are you willing to pay 1,500,000 for the something insurance for something that costs 1 million? That's the question. How much insurance is acceptable for you, or profitable or beneficial to you? This is it. Have I talked too much? Yes, I did. 32 minutes. That's enough, George. So this is it. So it was an important question. So simple hedging strategies that have stood time. If you have any question, suggestion, feel free to put in the comment section. And to course, I will be back again recording another tutorial to answer your specific question. All right. If this video has been totally useful to you, please let us know by giving us the thumbs up. If you dislike it, be sure to mark it down. If you think that is an essential tutorial, feel free to share it on the social media. Subscribe to our YouTube channel. Our YouTube channel is George Trio. Be sure to click on the notification bell so anytime we record a new video, you will be the first person to be notified. Until the next time, enjoy yourself and be very happy. We are the TSTW SYS008 traders talking about simple hedging strategies that have stood time. We were talking about gold, dollar, stock market, commodity, and bonds. Bonds, we must think of interest rate and certain bank, dollar, same thing. All right, stock market means that there's a demand for gold in that particular country. The stock market has a high chance to go up. All right, when the stock market is about to go down, the sector that will benefit from it will be commodity market. All right, so gold, commodity against the stock market. Happy to meet you all, and I will speak to you soon. Thank you for watching this video in full. All right.